Hi, everyone. First one.
Hello.
Hey. All right. Before we get into it, I might get the panelists to introduce themselves and a little bit about the company. So ladies first.
Thank you very much, everyone. My name is Valeriya, and I'm doing partnerships and communications for 1inch Network. For those not familiar, 1inch does some really good parties around crypto events, but what's more, we're the second largest DeFi protocol, and we aggregate liquidity across different DEXs on 10 different chains, offering users the best rates when they swap. Under 2 years, a real unicorn developed on the hackathon. In December, we closed the Series B to now build an institutional product. So great to be on stage with the big guys like you. Thank you.
Peter?
Hey everybody, I'm from IBM, so big shock, you're probably like, why am I sitting on stage? IBM has been, obviously involved with Hyperledger Fabric and all that kind of stuff, but I don't do any of that, okay? I'm like a plumber for institutionals, crypto wallets essentially, right? So Coinbase and, oh wait, not Coinbase, maybe someday. More like Citi, BNP Paribas, and large institutions. They're not going to use a ledger to do their crypto, right? They need something a little bit more robust. That's what we do.
Marwan.
Thanks for having me. So, hi everyone. My name is Marwan. I am from Consensus. So, Consensus is it's essentially a big name, but maybe you recognize some of the products. We have the most popular wallet, MetaMask. We have also some tools for developers to build their applications. We do participate a lot in the Ethereum ecosystem. So, it's quite an exciting company to be part of. I personally focus a lot on the DeFi and wallet space, and so I'll be keen to really talk to anybody who's building an interesting project. I'm very excited to be here to share the stage with such big names, and I wanted to just make a shout out to my 3 fans. 2 are eating pizza and they're not listening. Yeah, thank you. All right, thank you for having me.
Over to you, Sagar.
Thanks, Stephen, for having us, and thanks, Coinbase team. Hey everyone, my name is Sagar Desai. I'm part of Coinbase's institutional sales trading and prime team, and I'm based out of Singapore. Coinbase, as most of you would know, we, at least on the institutional side, we help large, long-term institutional investors allocate capital to crypto in various ways. Either that could be actually providing them a trading platform or a prime brokerage platform, or helping them custodize their assets in cold storage. Besides a variety of other products that we help clients with on the retail side. So yeah, very excited to see you all here and very excited to share the stage with all of these guys. Thanks, Stephen.
Cool, let's kick it off. Maybe by age this time, by tech age, just to be clear. Peter, you've been in the tech space for quite a long time. You've obviously seen a lot of trends happening. What aspects of DeFi do you think make it a threat to conventional banking and financial institutions?
Yeah, so it's a really interesting question. If you're a financial institution, you might not actually think that DeFi is so much of a threat. Think about the problems that a big bank has today, right? It's centralized, okay? And if it's centralized, you can basically are limited to certain things that you can do, right? Setting rates and things of that nature. It's completely inefficient, right? It takes 3, 4, or 5 days to do a wire transfer. It's not interoperable. If you try to combine TradFi infrastructure, good luck with that, right? It's opaque. You have no idea what's going on behind the scenes. And so there's all of these different reasons why TradFi, if you will, is looking at DeFi, okay? And it's more than just simply, because it's a cool tech fad or whatever, right? There's fundamentally better things that can happen. Efficiencies, right? Today, if you wanted to launch a product for $200 million, you're going to have to get like an army of people to do it. Well, if you're talking about a smart contract, it doesn't matter whether it's $200 million or $10, right? It doesn't matter. It's just software code. So efficiency is really, really key. Instantaneous settlement and clearing and those kinds of things. So if you are an institution, you're absolutely looking at this space. Not only because it's just like, it's there, it's because it makes you more competitive. You can reduce costs, increase efficiencies, automate processes, and those kinds of things. That's what the institutions are really interested in. And so when you think about challenges, then it's like, well, okay, as a lender, I know who my counterparty is, right? But if you're lending in a DeFi platform, do you know who your counterparty is? You know, it's like anonymous. You know, what's the credit risk there? I think we all know about that recently, right? You know, so what's their cash flow like and so forth? Who they lend it to? Have they rehypothecated your stuff? You know, just ask the guys that hold or not. You know, so there's a whole lot of things to concern yourself if you are an institution looking at this. And you have examples of like Aave Arc, which is trying to create permissioned pools of liquidity, which is good because then you know KYC who you're dealing with, right? But how do you know about those transactions? Were they in Tornado Cash recently? You know, who knows? So the whole provenance of the cryptocurrencies themselves, the tokens and so forth, do matter because these are regulated institutions. You know, DeFi is not going to challenge Citi. Okay, it's going to be more like the lines that Citi, as a regulated institution, okay, is going to adopt DeFi platforms in order to compete and make themselves more relevant. Because you know, you're probably all familiar with the term MetaFi, which is sort of like this combination of TradFi and CeFi and DeFi, and it's set up basically getting set up for the metaverse, right? I mean, Citi put out a paper on this just recently. So these guys are all looking at this, and so the challenge is how do I deal with a smart contract instead of how do I deal with a counterparty? Those are the kinds of things that they need to solve.
Anyone else on threat
Yeah,
or even opportunity?
I would like to add a perspective to that as well. It's not really so much of a threat. I think institution and TradFi should look at DeFi as an opportunity. And the reason being here is that most of the DeFi projects are really, you know, on the forefront of innovation, and they try in technology that is quite powerful and quite efficient compared to the traditional finance. And then the institutions and the TradFi companies have this opportunity to watch the space and see what kind of like DeFi protocols are building, what are the pros and cons of each one of them, and incorporate that technology into their space. So it's very similar to, although more radical, but it's a bit similar to what fintech happened when these fintechs started showing up and then innovating on the UX UI of the users. I think many of the TradFi institutions actually took advantage of that innovation and they incorporated it into their apps and you know positioned themselves very well in that market. And the same is happening with DeFi. There is more innovation on the back end. There is more innovation on the efficiency, on the process, on the transactions, on some of the financial products, and it's a place and a space for institutions to watch and learn from it and incorporate some of those innovation to the company.
Just building on Marvin's point, I think the other thing is when we compare TradFi and DeFi, a lot of the products that are offered by DeFi today, they are essentially just replica of what a traditional financial institution offers. Lending, earning a yield on custody assets. These are all, mortgage. These are all very similar products. So I think one area of opportunity for DeFi is to really think about what are some of the new products that can come to the market. So for example, I know in the insurance space, we have like a Nexus Mutual. And that's actually really innovating, or at least putting out new innovative products from a DeFi perspective. So yeah, that's one area of opportunity that I think DeFi should focus on.
Valeriya, you've seen like the rise of consumer adoption, obviously, from DeFi. Now that you're launching 1inch Pro, how do you think institutions can benefit from DeFi?
Very good question. I agree with what everyone else has said, and I believe institutions can always benefit from the new and innovative technology and the approaches, and these approaches could transform and improve the current products that institutions are offering. There are already a lot of institutions that benefit from the DeFi ecosystems, and if we look at the world in global, the finance system is a little bit broken right now and has a lot of the pitfalls that could be fixed by technology. I believe one of the large use cases that institutions could benefit from would be stablecoins. A lot of the countries globally, around I think 87 countries, are now considering issuing their own central bank digital currencies. You name it, US, UK, Sweden, all of these are testing and approaching a lot of the projects to cooperate with them in certain sandboxes. Also, if you look at the Forex market, for example, right now it's impossible to buy, let's say, a $1 million worth of Tesla stock in one single transaction. And I believe DeFi could solve that problem eventually and make transactions much more efficient for institutions, faster, secure. But in order for institutions to truly benefit from the ecosystem, we need an institutional grade DeFi platform which offers the QIC and AML checks in place, because DeFi right now is a lot of unknown participants with potentially gray liquidity and a lack of transparency, and that's no good for institutions. So this is exactly why we are building 1inch Pro solutions to finally start working with institutions, as we plan to customize our protocols and provide the necessary QIC, QIB checks and the licenses and interact with institutions via permission pools. So,
Marwan, did you want to
I think
talk about
I'm going to go ahead and
benefits?
jump in here. What did we learn from Celsius? It's like, we're sort of in this crypto winter, right? But everybody knows the word risk management, right? Everybody knows that now. If you didn't know that before, you know it now, right? And it's all about, under collateralized lending, which is obviously something that we've all learned too. So, getting back to kind of like the benefits of DeFi for, institutions, Onyx, which is a branch of JPMC, recently talked about, bringing in terms of collateral, how about mutual funds, right? How about stocks and bonds and traditional assets, and they're tokenized, and make that the collateral on these DeFi lending platforms like Aave. And now you can actually rely on something. It's a real world asset, right? So that's something that I think is interesting. Right now, Siam Commercial Bank in Thailand recently did a deal with Compound, a Compound Treasury. It's a very simple model. You put in $1 and you get back the dollar plus 4% interest, okay? And it's all collateralized based on stablecoins that actually are, backed by real reserves. Another example, Huntington Valley Bank outside of Philadelphia in the U.S. I'm from the U.S., pretty close to that area. It's a community bank. They just did, with Maker, $100 million to create a whole new vault. And basically, it's the same idea. So they're going to have DAI, okay, backed by, instead of USDC, sorry, Circle, but actually, real TradFi assets and so forth. So I think you're seeing kind of like these opportunistic ways for TradFi to really make the whole experience in DeFi better, right? Because then you don't have to worry so much about, what's really happening behind the scenes, as we've certainly learned the hard way, I would say, in the last few months.
Yeah, so I'll add a little bit as well, because like Peter said, actually, from an institution's point of view, it's interesting to look at assets that are backed by real-world assets and then bring those in terms of the financial system they're interacting with. But very similar also to what 1inch is doing with the Pro version. It's an opportunity for all of the software providers and infrastructure providers to also bring a Pro version for the institutions. So many of you know the MetaMask Orange, and you're probably using it for your everyday life, but then we saw a need essentially in consensus that the institution needs something a bit more robust. And we went and interviewed a lot of the funds and a lot of the investors, and we found that they're just like having a hot wallet essentially where they're transacting. And so we've launched a couple of months back also you'd call it a Pro version. It's called MetaMask Institutional. It's a Blue Fox. And it's really just adds to the initial wallet the features that institutions will need. So think like KYT for transaction tracking, AML, thorough portfolio tracking, and more importantly, integration with custodians. And we have a few of the partners here today to really bring that additional layer that the institutions need. And so two things, like you said, it's the assets themselves have to have like a real value, and that will bring a lot of the trust into the system. The tools as well and the protocols that you trade on, have to also have that maturity added to it.
Sagar, we just discussed some of the benefits there. But obviously this year, to Peter's point, we've seen some spectacular collapses in the crypto space. And there's a lot of institutions obviously wanting to get in. So, in your point of view, what are the biggest traps for institutions looking to get into crypto and DeFi?
You saved the most difficult question for me. Look, I think, first of all, I think we need to move away from the viewpoint that this is a crypto problem. this is not a crypto problem at all. This is a credit risk management problem. And this could happen in traditional finance. This could happen in any industry, any corporate that doesn't manage risk well. What does risk management or solid risk management look like? First of all, solid due diligence standards. Do you do due diligence on your counterparties and make sure that what they're actually saying in public is matching against what they're reporting publicly? What else? As in, when you think about, are you thinking about risk from a variety of considerations, including volatility, including stress testing your portfolios, including ensuring that your liabilities or short-term liabilities match against short-term assets and long-term liabilities match against long-term assets? So thinking about risk management in a very with a very institutional lens, I think is going to be key for any platform that wants to build a long, sustainable future for itself. So that's one. And then the second point that I would quickly make is, even when you think about what happened with folks like Celsius, 3AC, it was essentially a repetition of what we've already seen. We've seen that in TradFi. We've seen that with long-term capital management in the 1990s, Lehman Brothers in 2000. So this is nothing really new. It just requires everyone to become more mature, which is good for the industry, and then also ensure that you have a competent team in place that is A, experienced, B, has seen different market cycles, and then C, wants to build a sustainable future for crypto.
Maybe over to Valeriya as well. Like, what are some of the traps that you're seeing as you're starting to, shift your product to have an institutional play as well?
Sorry, what's the question again?
What are the traps for institutions looking to get into the space?
I think from what Sagar said is exactly correct, but also, as I mentioned before, just interacting with unknown players and mixing up the funds with the gray liquidity and lack of transparency that we currently have.
Market cycles, Peter, to Sagar's point, what kind of learnings can people getting into DeFi, or institutions getting into DeFi specifically, take from those previous market cycles?
Well, I think, again, when I talk with the large institutions like Citi and the bank, I deal with all those big tier one banks, right? They don't really care so much about the assets. They don't care about the specific coins. They don't really care about the platforms either. What they care about is the tech, because it can solve a lot of problems for them, okay? In terms of, we talked a little bit about some of those earlier. So it's, for these guys, they take the long view, okay? And they're constantly building things. You'd probably be surprised that a lot of these tier one banks, global banks, have already tokenized all of their treasuries. And they're actually going to use that, for their lending services and other kinds of things. So I think you're seeing just kind of the long approach, okay, for these institutions. It's not like a cyclical thing. It's not driven by consumer, demand or not demand, right? I mean, our market, quite frankly, is just, it's like number go up and keeps on going, because more and more institutions are starting to see the light that, hey, you know what, I can do a new business model here, lending, staking, yield farming, what have you, on top of everything else that I do, right? And I can just offer a basic account and basic access, because one of the things that traditional banks have is familiarity and trust with their customers at the end of the day, right? How many people do not have a bank account out there? If you do not have a bank account, raise your hand.
Ask how many they have, how many bank accounts, like
so
2 or 3.
You trust somebody, you trust your bank, right? So when they offer crypto, or they most likely not real, the banks aren't really doing crypto, guys. The banks are doing tokenized assets. They're doing digitally native bonds, those kinds of things, because the regulations, quite frankly, aren't there yet in order for them to safely go ahead and start doing crypto and then later on get busted for it, right? They don't want to get OFAC'd. We've seen a little bit of that lately, right? So, the banks are basically starting off slow, but the key thing here is this. They're adding to the portfolio that they already have. And that's basically how it starts to work. And from a custody perspective, because that's what my line of business is, they'll do sub-custody with like Coinbase or people, the gold standards out there. And then eventually do what they call institutional self-custody, and then start to build processes on top of that. The challenge for these banks is what I call the target operating model. Okay, you want to do lending. That sounds great on paper. How many people at the bank know how to do that with crypto? Okay, exactly how does that work? How do you onboard somebody? How do you originate a loan? Right? How do you deal with forks? How do you service that loan? How do you in traditional business, these guys know how to do it. But there's a huge brain drain going on right now. If you know anything about crypto and you were at a big bank, you've probably already left. Okay? So they have this constant need. Hey, it's great for us because we have a consulting business. It's awesome. We love it. Keep draining the brains so that we have opportunities. That aside. But, the other things that these banks are facing is customer retention. If you don't offer access to digital assets, right? Then as a customer, you're going to go find someone that does. If you're a fund or, a venture capitalist fund or whatever, you're going to go where the money is, where you can find opportunities, right? So it's a necessary evil for these banks to figure out how best to do this. And I would say this, they're all exploring. Every single bank is looking at this. Every single bank. You may not know it, and they may not say it, but it's happening. So it's really, we're just at the beginning from an institutional perspective, right? Yeah.
I would also say that, I wouldn't fully agree that banks don't care about crypto market cycles because maybe, there are different parts of a bank. Some care more about the crypto market cycle and some less so. Obviously, if you're talking to the wealth management or the asset management side of a large multinational, obviously they would be concerned about a crypto winter event or a bear market or a bull market. Typically, we've seen that a lot of these fintechs have gotten or entered into crypto when crypto was in the bull market. What we have now started seeing is that a lot of banks have gotten serious about crypto, especially because it's a bear market, because it's the right time for them to build and then also be able to invest some of their own capital in crypto assets. Because a lot of them are seeing this as a perfect opportunity to invest capital and then be able to materialize the upside when that happens in a couple of years. So yeah, I would say they care about all parts of digital assets.
Maybe one of the final questions, starting with Marwan. Especially through MetaMask, you've seen a huge adoption of DeFi and crypto. And that was led predominantly by consumers. But in the next 3 years, what percentage of financial institutions' portfolio would comprise of crypto?
Yeah, so I think there is a general agreement that DeFi started with the consumers, with the retail space. I think in the recent few months we saw an explosion of the MetaMask users, over 30 million, I think, interacting with it. Few things obviously happened. These crashes, these rugs and whatnot, and that really got the attention of regulators, right? So there is essentially two types of regulator. If you are an institution, it's your government. If you are retail, it's your wife, right? So you essentially have to know how to navigate those and take advantage, how to educate them, and then get your way through the regulation that they will come up with. And obviously, I would expect institutions to be more shrewd in that work. They have, of course, the expertise and whatnot, and they will be able to leverage that. The second part is institutions, of course, have bigger funds, and they are really trying to understand how these trading and mechanisms are happening on chain and how to maximize that through arbitrage and other sophisticated methodologies that retail will not be able to leverage that. I'm afraid actually retail will be kind of pushed out of the space, and there will not be much more gains for them. So with that, I really see the percentage of the portfolio on chain, let's say, growing, and the trading growing to the institutional side, happening in much bigger volumes and much bigger transactions. And then as institutions start applying the right technology, the right infrastructure, and investing in the right assets that are, risk validated and vetted, we will see a growth in their portfolio percentage. I don't know, I'll say 10% is already a good amount.
I want to pick on that number a little bit. Okay, guys. The Bank of International Settlements has done a study on crypto adoption by institutions, right? And I happen to know what that number is. I don't think you do. So this is a great opportunity to play a guessing game. How many of you guys would say that 5% of institutions out there have adopted crypto? Can I have a show of hands for 5%?
Currently,
5%.
currently, already?
Right now. Oh, no, let's make it the next 3 years.
3 years.
At the end of 3 years from now, 5% of institutions will have crypto. Come on over here. If you're working in this space, you should have your hand up, by the way. Yeah, okay. Very good. Yep. Very good. How about 10%? 10? How about the rest of you who don't have an opinion? What the hell?
More.
More? Whoa, more. 15? Higher than 50? Greater than 15%?
More than 50.
Holy cow! I like this crowd. All right, we're all in it. Hey, we're all in this together, though, right? We want that to be the case. But you know what the current number is today?
55.
No, today, right now, the number of BIS, the number of institutions, it's 0.02. 0.02. That's what it is today, folks. We got a long way to go. Okay? But we're going to get there. You know why? Because we're going to still have these little gigs and keep talking up here and so forth because we're going to build this market together. But we think at IBM, we're forecasting between 1% and 4%. When I ask the same questions to all of our clients, which are like HSBCs and Cities and BNP Paribas, I mean, this is all people we deal with, right? They're all basically saying less than 5%. So the number is around, let's say, 1 to 5% of all institutions next 3 years.
Valeriya, you sound like...
Yeah,
And if I'm wrong, I'll buy you all a drink.
There you go.
quick point. Actually, I want to argue this number. I believe there's a lot more institutions that are involved, but they're just doing it silently and through some third parties. There's some data I've read by who? By Blog Data, and they actually reported that 55% of world's top 100 banks have invested in digital assets. They're investing in blockchain companies and VCs. For example, if we take BlackRock, they've invested in Circle, Anchorage Digital, FTX, and a lot of the big guys like PayPal, Samsung are already playing with crypto and are talking with different projects. We know JP Morgan issued their coin and currently using it as payments. So I think this number is much bigger, but they're just not doing it publicly, more through some venture arms or third arms. We don't know.
Yeah. So from a 1 inch perspective,
my comment, though, was more about banks offering crypto as part of their portfolios and so forth. So to your point, I mean, if you've invested in it and so forth, yeah, probably a different number.
So you're more bullish, Valeriya?
Yeah.
We're going to come back here in 3 years to see who's right.
So we'll be back here in 3 years and Peter might buy us drinks.
Yeah.
Let's see. Let's cigar over
This is
to you.
sadly
What's
the
your
end.
prediction?
Sorry.
What's your prediction in the next 3 years for penetration?
It's a difficult number to predict, but from at least from an investment perspective, what we are seeing across all institutional portfolios, including folks like sovereigns, pensions, endowments, I think right now they're at about 1%, and we think in the next 2 or 3 years, that could go to anywhere between 3 to 5%, which for a large institutional portfolio is a lot. Because obviously these portfolios are running in trillions of dollars of assets. So yeah, that's the number.
We're talking thousands of banks at just 1%. I mean, this is a big number. And also money service businesses and so forth, yeah.
Yeah.
So we're going to continue this chat over in the breakout area. Before we head out to the breakout area, though, aside from this prediction, I just wanted to get like some key points. Like, what key insight did you want to share at the breakout area? Valeriya, maybe?
Let's talk DeFi and institutions.
Peter?
Always trust your money to yourself, not a third party.
Marwan?
Self-custody all the way, but more importantly, I think sustainable DeFi, projects that can last for a couple of years and you don't see the coin just shooting up and then, going to sleep. That's the main thing.
If you're serious about crypto, you got to invest with Coinbase.
All right. Thank you so much, guys. For those of you who want to connect with the panelists, we're going to head out to the breakout room so you can connect with them and dive deeper into the topic. Thanks, guys.
Thank you.
so much.